The Fed has just released the minutes from its March meeting. The summary of economic projections crossed earlier than expected today. Economics editor Mike McKee has a breakdown of those minutes. Mike?
This is a rather extraordinary development, Betty. It seems the Fed inadvertently sent the minutes and the economic projections out to members of Congress and some trade groups yesterday afternoon. It is possible that some people traded on this information. We just don't have enough details yet. Of course, the thing to keep in mind when reading these minutes is that this meeting was before the March payrolls report came out weaker than expected. But here's what they were thinking at the time. The economic situation had improved, the labor market was getting better, and they were beginning to discuss whether or not they should start tapering off their QE bond buying of mortgage-backed securities and Treasury securities. Here's a couple of key quotes from the minutes. Many participants, now this is the broader discussion, including some of those who were focused on the increasing risks, expressed the view that continued solid improvement in the labor market could prompt the committee to slow the pace of purchases beginning at some point over the next several meetings. All but a few participants thought that, given the current economic outlook, it would be appropriate for the committee to continue purchasing MBS and longer-term Treasury securities at about the current pace, at least through mid-year. That's the money quote for people in the markets. That before the March payrolls report came out, they were beginning to think about tapering it over the next several meetings, perhaps as early as the late June meeting. So we'll continue to look through these minutes. Again, they were released much earlier because they were inadvertently sent out to members of Congress and trade groups yesterday. So we've got the minutes now. We'll continue to look through them, Betty, and give you any more relevant information. But that's the key point at this point. That it is possible that we're going to see tapering if we get back to stronger job growth earlier this year.
That is very interesting, Mike, and certainly something that the investors today will hone in on, which is this idea that QE may be pulled back possibly by, starting by the middle of this year. But Mike, I mean, do you think things might have changed, though, because this came out, of course, all before we had that jobs report?
Well, that's hard to say. And most of the Fed officials who have spoken since the job report say they're kind of looking past it because it could be just a one-off. It could be sort of noise in the sequence of numbers. They're going to want to see several months' worth. Now, Dennis Lockhart from Atlanta, who spoke this morning, said he was disappointed in the numbers, and if that continued, he would even consider raising the amount of bond purchases. But most of the others seem to think at this point that tapering is on the menu, and we've heard it from people like Janet Yellen since this meeting, the vice chairman of the Fed. So it does look like this is something they're considering if we can see job growth bounce up again in the coming months.
Mike, lots of people were talking about how, how this stock market rally has been fueled by the Fed. And the wonder or the concern is, how do they pull back from all this QE? And we didn't really get a whole lot of detail in those minutes on that.
No, it's not described, but they did talk at length about the risks of buying too much for too long, including asset market bubbles. That's one of the top concerns that was expressed during the meeting. They had a very lengthy talk about this. They also worry about the effect on the bond market when they do start pulling back, that there could be some enormous losses because people are very long into treasuries right now. So the Fed is worried about how they get out of all this, and that's why they're talking a lot about tapering. Maybe if we do it on a gradual basis, people can adjust. The question is, when they first suggest it's going to happen, does everybody rush for the exits at once?
Absolutely. I mean, whether or not we're going to see those sell-offs. And just on a final note, Mike, just getting away from the minutes and talking about the budget, because I know you've been looking at this. The president's going to be releasing their budget. The economic projections in what is going to be outlined, what do they say about the economy?
Well, they're suggesting the economy is going to continue to grow, but the projections are way out of date. Everybody has to build their budget assumptions. All of the agencies and divisions have to build them on the economic projections, what they think is going to happen to the economy. And this budget began to be put together in October. So those numbers are from October. You can't really take them seriously. We'll get a mid-year update from the administration at some point. But if you want to figure out what's likely to happen, look to the CBO rather than the president's budget.